system works is that step 1, the government creates glorified IOUs. These bonds increase our national debt and put the public on the hook to pay it back. Step 2, IOUs are swapped to create currency. The Treasury sells the bonds to the banks. The banks then turn around and sell our national debt at a profit to the Federal Reserve, which they probably own. The Federal Reserve then opens its checkbook that doesn't have a penny in it and buys those IOUs with IOUs that it writes, checks, on a checking account that has a zero balance. Then they give those checks to the banks and currency just springs into existence, and then the whole process repeats. This results in a buildup of bonds at the Federal Reserve and currency at the Treasury, which is really just a supply of numbers. The Treasury then deposits the numbers in the various branches of the government, and we get to step 3. The government spends the numbers on promises, public works, social programs, and war. Then the government employees, contractors, and soldiers deposit their pay into the banks, and we get to step 4, where the banks multiply the numbers by magically inventing more IOUs through fractional reserve lending, where they steal a portion of everyone's deposit and lend it out. That currency gets redeposited, and then a portion is stolen again, and the process repeats over and over, magnifying the currency supply exponentially. Then we work for some of those numbers, which brings us to step 5, where our numbers are taxed. We pay tax to the IRS, who then turns our numbers over to the Treasury, so the Treasury can pay the principal plus the interest on bonds that were purchased by the Federal Reserve with a check from nothing. Then we get to step 6, the debt ceiling delusion. The system is designed to require ever-increasing levels of debt and will eventually collapse under its own weight because politicians always kick the can down the road. They don't want it to collapse on their watch. And finally, step 7, the secret owners take their cut. The world's largest banks own the Federal Reserve. Those banks make a profit selling our national debt to the Fed. They make a profit when the Fed pays them interest on the reserves held at the Fed, and the Fed pays them a 6% dividend on their ownership of the Fed. This system is fundamentally evil. It funnels wealth from the working population to the government and the banking sector. It is the cause of the artificial booms and busts of modern economies, and it causes great disparity of wealth between the rich and the working class. It all starts when some politician says, "Vote for me and I'll make sure the government provides you more free stuff than my opponent will." But there's no such thing as a free lunch. So to provide that supposedly free stuff, the politicians vote for the country to spend more than its income. This is called deficit spending. To pay for that deficit spending, the Treasury borrows currency by issuing a bond. So what's a bond? If you think about it, a bond is really nothing but a glorified IOU. It's a pretty piece of paper with numbers printed on it that says, "Loan me $1 trillion today, and I promise over a 10-year period I'm going to pay you back that $1 trillion plus interest." But what you need to understand is that Treasury bonds are our national debt. These glorified IOUs are to be paid back by you and I and our descendants through future taxation. Therefore, when the government issues a bond, it steals prosperity out of the future so that it can spend it today. The Treasury then holds a bond auction, and the world's largest banks show up and compete to buy part of our national debt and make a profit on it by earning interest. You'll notice that as we move through this process, the big banks are there, taking a cut every step of the way. This isn't by chance, as you'll see shortly. Then, through a shell game called open market operations, the banks get to sell some of those bonds to the Federal Reserve at a profit. To pay for the bonds, the Federal Reserve opens up its big old checkbook and writes bad, bogus, counterfeit checks that should bounce because they're drawn on an account that always has a zero balance. There isn't one penny in there. To quote from the Boston Federal Reserve, "When you or I write a check, there must be sufficient funds in our account to cover that check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money." The Fed then hands those checks to the banks, and at this point, currency springs into existence. The banks then take that currency and buy more bonds at the next Treasury auction. But what is a check? A check is also an IOU. When you write a check, you're making a note that says, "Here's my IOU for cash. All you have to do is go to the bank and pick it up." Now, it's very, very important that you understand this process, because we're going to come back later and show you the devastating effect this has on you. The Treasury issues IOUs, bonds. The banks then buy those IOUs with currency. The Federal Reserve then writes IOUs, checks, and hands them to the banks in exchange for the Treasury's IOUs, the bonds. And currency is created. So what's really happening is the Federal Reserve and the Treasury are just swapping IOUs, using the banks as middlemen, and abracadabra, presto, currency magically springs into existence. This process repeats and repeats over and over again, enriching the banks and indebting the public by raising the national debt. The end result is that there's a buildup of bonds at the Federal Reserve and currency at the Treasury. This process is also where all paper currency comes from. The Federal Reserve and the government mistakenly call it base money because they didn't watch episode 1 of this series and they don't know the difference between money and currency. But I will correctly refer to it as base currency because it is not money. It is currency, and as we've learned, there is a big difference. Money has to be a store of value and maintain its purchasing power over long periods of time. We learned in episode 1 that earlier in our history, our paper currency was just a claim check. It was a representation for real money of intrinsic value, the gold and silver that was held on deposit at the Treasury. You could walk into any bank and slap your currency, like say a $20 bill, on the counter and redeem it for real money, a $20 gold piece. But now, this base currency that's piling up back here is really nothing but a receipt or a claim check on an IOU, that bond. So it's really nothing but a supply of numbers. The Treasury then deposits the newly created currency into the various branches of the government, and the politicians say, "Hey, thanks for that." And the government does some deficit spending on public works, social programs, and war. The government employees, contractors, and soldiers then deposit their pay in the banks. Now, this may come as a shock to you, but when you deposit your currency with the bank, you're not actually depositing it into an account to be safely held in trust for you. Instead, you're actually loaning the bank your currency, and within certain legal limits, they can do with it pretty much anything they please. This includes gambling in the stock market and loaning it out, at a profit, of course. Now this is where the machine of currency creation really gets cranking, because this is where something called fractional reserve lending comes into play. Fractional reserve lending is exactly what it says. The banks are allowed to reserve only a fraction of your deposit and loan the rest out. Although reserve ratios may vary, I'm going to use a 10% reserve ratio as our example. If you deposit $100 in your account, the bank can legally take $90 of it and loan it out without telling you. The bank must hold $10 of your deposit in reserve just in case you want some of it. These reserves are called vault cash. But why does your bank account still say you have $100 if the bank has stolen $90 of it? Because the bank left IOUs it created, called bank credit, in its place. Now I know this sounds crazy, but here it is in black and white from the Fed. Commercial banks create checkbook money when they grant a loan simply by adding new deposit dollars in accounts on their books in exchange for a borrower's IOU. These are nothing but numbers that the banks type into their computers. And even though these bank credit IOU numbers are very different from base currency numbers, because they only exist in computers, they are still currency. So now there is $190 in existence. Now, the reason people take out loans from the banks is to buy something. They're going to buy a house or a car or something like that. So the borrower takes the $90 that the bank loaned to him from your account, and he pays the seller of the item. But then the seller deposits that currency into his account, and his bank loans out 90% of that and leaves bank credit numbers in its place. So now there's $271 in existence. This process repeats and repeats until under a 10% reserve ratio, an initial deposit of just $100 can create up to $1,000 of bank credit, all backed by $100 of vault cash, just 10%. But as I said, reserve ratios vary wildly. On some deposits, it's 10%, on others, it's 3%, and on some forms of deposits, reserve requirements are 0. The result is that the expansion of the currency supply by the banks is far greater than even this example would lead you to believe. Yes, this system has owners. Who they are is an even bigger secret that we'll get to shortly. But first, we need to understand the mumbo-jumbo of the so-called debt ceiling. It's all based on a huge paradox. There was interest due on that bond, and there was interest due on every one of those loans that the banks made. That means that there is interest due on every dollar in existence. Let me ask you something. If you borrow the very first dollar into existence, and that's the only dollar that exists on the planet, but you promise to pay it back plus another dollar's worth of interest, where do you get the second dollar to pay the interest? The answer is that you have to borrow that one into existence and promise to pay it back with interest as well. So now there are $2 in existence, but you owe 4, and so on and so on. The result is there's never enough currency to pay the debt. There is always more debt in the system than there is currency in existence to pay the debt. Therefore, the whole system is impossible. It is finite. It will come to an end one day. What would happen if the government stopped borrowing to do deficit spending? Are the payments on those treasury bonds going to stop? What would happen if the public stopped borrowing and going deeper into debt? Are your house and car payments going to stop? No. There is a payment due every month on the principal plus the interest on every dollar in existence, and those payments do not stop. If we stop borrowing, then no new currency is created to replace the currency that we used to make those payments. Whether you're making a payment on a loan or paying tax to make a payment on a bond, the portion of the payment that goes to pay off the principal extinguishes that portion of the debt. But the debt also extinguishes the currency. Currency and debt are like matter and antimatter. When they meet, they annihilate each other. If we just pay off the principal only on all the loans and bonds that exist, the entire currency supply just vanishes. So if we don't go deeper into debt every year, look what happens. The whole thing goes into a deflationary collapse under the weight of those payments. Politicians and pundits alike talk about balancing the budget, paying down the debt, and living within our means. They don't understand that that is deflationary. It is impossible to do under our current monetary system without collapsing the whole economy. This is why any talk of a debt ceiling is not only ridiculous, it's delusional. The system is designed to require ever-increasing levels of debt just to continue. And that's why politicians will always kick the can down the road and raise this so-called debt ceiling over and over again until the whole system finally collapses under its own weight. In other words, they don't want it to collapse on their watch.
Number 2, metal money. Once people start using money to facilitate trade, whether in the form of shells, barley, feathers, or whale's teeth, some useful characteristics of money become apparent. Barley, for example, is heavy to carry, so not portable or even durable. Whale's teeth are hard to split into two, so not easily divisible. Shells can be picked up on any beach. Yippee! So not exactly scarce. And if the token standing as money doesn't have much intrinsic value, like feathers, it's hard to trade outside your immediate community. Another noticeable feature of money was that having a lot of it made you powerful, and power could get you a lot of it. So kings hit on the idea of minting coins from precious metals, stamping them with an emblem that guaranteed their weight and value. Metal money ticked all the money boxes, and because it had intrinsic value, it could be used to trade with other communities. But the success of metal money brought temptation, and sovereigns soon realized that by slimming down the coins or slipping cheaper base metals into the mix, they could make money by circulating debased currency worth less than face value. In the 18th century, the British forced their colonies in America to pay their taxes in pounds, and they made it illegal for the British colonies to print their own money. This meant that the colonies were forced to trade with the motherland to access the currency. According to Benjamin Franklin, the American War of Independence was caused by the sheer burden of British taxation and the disadvantageous trade needed to access British pounds. And the hard-won freedom after the war allowed the Americans to create the American dollar, which, because of the country's vast trade and trustworthy tax base, eventually became the most widely used currency on the planet, leading many countries, including Britain, to store large reserves of dollars. But by choosing to keep a reserve currency in dollars, the UK ceded at least some power back to those runaway Americans. Number 7. Money and building banks. By the 19th century, banking had become a thoroughly respectable business. Making a profit by basic money lending, banks paid a lower rate of interest for the money they took in than they charged on the money they loaned out. But the banks soon realised that as long as depositors didn't all ask for their money at once, they could in fact lend out many times more money than they had on deposit. This is known as fractional reserve banking. On rare occasions when depositors all tried to get their money out at once, there was a run on the bank. And the effect on the wider economy was so serious that government started to insure customers' deposits to prevent it happening, and thereby enabling banks to loan out more and more. By the 21st century, some banks had taken fractional reserve banking to a whole new level, funding most of their loans not from cash deposits from savers, but with loans from other banks, often secured against bundles of previous loans. So when there was a run on the bank in 2007, banks like Northern Rock not only didn't have enough money to pay out, but the effect went way beyond just one bank. Number 9. The power of money. Since the last traces of a gold standard disappeared in 1973, the world has carried on trading in US dollars even though these aren't backed by anything of intrinsic worth. The US government's decision to borrow billions for its bank rescue and stimulus plan dramatically increased the supply of dollars, and some predicted that this would lead to a big fall in the dollar's value, on the basis that economies which print money so they can consume more than they produce will suffer price inflation and exchange rate depreciation. But 6 years on, this still hasn't happened. Why then does the dollar retain its value? Perhaps with so much of the world holding its wealth in US dollar assets, people simply have faith that the dollar will retain its value. And the knowledge that so many others share that faith reinforces the general optimism that the dollar will stay strong. Number 10. Future money. Minted coins and paper money, once the cutting edge of technology, are now used in only 2% of transactions. Credit card and electronic banking technology has enabled massive global transactions to take place in the fraction of a second. And digital technology is enabling new currencies to be created. Linden dollars, Bitcoin, and other cryptocurrencies, which exhibit the enduring characteristics of money, being hard to forge, durable, portable, divisible, and limited in supply, and which may even challenge the power of government-backed money. But until a government accepts taxes in Bitcoins or other privately issued currencies, or banks start lending in them, they are not much different from any other token, such as whale's teeth. One sign that a new form of money has become important will be when governments and banks try to control it. And if governments and banks continue to have the power to control money, those who use it will always wonder to what purpose will they put that power.